Hello and welcome to Charting the Markets. It's Monday the 27th of February, and by and large we're seeing a very positive start to the week that comes off the back of a week that has been dominated by selling pressure. Interestingly, that comes in the wake of numbers that by and large point towards economic strength. But the fact of the matter is that we saw a relatively hot PCE number coming out of the US, and if inflation doesn't continue to move towards the downside, then there's question marks about how happy people should be at economic outperformance, because it means higher for longer for interest rates. But it's not necessarily a one-way market, as we can see here. The pop that we're seeing in early trade today signaling the fact that we're likely to see a relatively choppy period going forward as people try to ascertain whether we should focus on the near term, which could see another extra 25 basis points added on to interest rates and potentially another month or so added on to the expectations for when we're going to actually cut interest rates. Bear in mind, we're looking at the US to cut interest rates for the first time in the back end of 2023. So December was priced prior to the PCE number coming out. Once that core PCE reading came out, we did see that shifted into 2024. But nonetheless, today we're seeing certainly some optimism within equity markets. And the question mark is whether that's going to be able to be sustained or whether it's just something that's going to be sold into once again. In terms of the economic calendar, it's a relatively quiet start to the week in terms of Europe. We have got some talks over the potential for a new deal over the Northern Ireland Protocol with the EU and the UK. But over in the US, we do have a focus on the pending home sales and the core durable goods numbers. That's going to be important. Looking forward the rest of the week, we've got Canadian GDP on Tuesday. We've got Australian inflation on Wednesday. Bank of England Bailey speaking also on that day. ISM manufacturing PMIs coming out of the US on Thursday. Friday, not a whole lot. Thursday, not a whole lot. And then Friday, some services PMI numbers coming out. So by and large, we're looking at a week that's not super busy in terms of economic data. We've got a couple of interesting names reporting in terms of retail over in the US, the likes of Costco and Target. But by and large, we're seeing a slowdown in terms of the earnings calendar over in the US as well. So really, we're seeing that focus likely to return back to everything economic, inflation and alike. Today, it seems like people are in a relatively optimistic mood. Whether that can last remains to be seen. Looking at the indices space, we've seen the FTSE 100 pop in towards the upside as we start the week, moving in towards this 79.49 crucially. This essentially comes off the back of a sell-off that we saw at the back end of the week that took us into and below the price swing low, but only marginally so. And certainly the rally that we've seen here points towards some innate strength that, those saying that we've topped out here in terms of equity markets might actually start to think otherwise on that evidence. This is the weekly time frame, and by and large, it's worth noting that the FTSE 100, when we do see equity markets roll over, the FTSE generally fares better than most. And that's because of the fact that generally when we see equity markets roll over, we see the US dollar coming back into strength. That weakness in terms of cable does benefit the FTSE 100. So this is almost a haven when things are going bad. But at the same time, when things are going well, generally the FTSE is not the big outperformer on the day. Here's a daily time frame. We can see that the pullback that we've seen recently essentially does just look like another retracement of a wider bullish trend. So really a breakdown through. You've got this sort of prior historical high of 76.90, but also just above that we've got the 77.07. So that zone really needs to break for us to look for a big wider pullback. Until that happens, the retracement that we've been seeing over the past week looks exactly that. It looks a pullback before we continue to move higher. But certainly if we were to rally from here on in, that'd be very notable, because we'd be looking at essentially just a 50% retracement, as you see on the nose pretty much there, and now starting to rally. So that really shows innate strength within this market. The idea that we've essentially topped out and we're going to see a big collapse in equities, not necessarily proving out at the moment. And the 4-hour chart shows you 79.49. That's the key level. If we break through that level, we've essentially got a little double bottom formation, and it points towards this potentially being the bottom and the end of that retracement. So look out for how we respect this 79.49. If we can move above it and hold above that and maintain price action, then there is a good chance that we switch into a more optimistic outlook from here. Until then, if we respect it and start to roll over, then you could just see this as a sort of consolidation phase before we see this market turn lower once again. Interestingly, like I said, generally when things are going well, the FTSE 100 underperforms, and we can see that here with the DAX. Big rebound coming into play here. Now, the daily time frame does highlight that the collapse we saw on Friday essentially took us into the bottom end of this zone of consolidation that we've been looking at recently. Essentially, if I was to just move this here so you can see this box separately. So you can see here we're looking at price action within this sort of range here around about 149.03 up to 152.72. The next leg higher took us into that next range. We've been consolidating around then since. Now, if we were to move this horizontal and push it to the level that we have at the lows here, you've got 152.44. Now, we pretty much closed around that level here on Friday, and now we're powering upwards once again. Does this mean that this is the beginning of the next big leg higher? Well, not necessarily, because if you look over the recent sort of month, I would say 25 days, so essentially the entirety of February, we've been within this latest range. So we're rebounding, but we're coming back towards the top end of this range. So there is a chance that we see the sellers coming back into play once again around about this prior peak that we have of 155.53 up to 156.56. So near term, yes, we could see further upside, but I do think there's risk that we do see the sellers come back into play around about this area to turn back towards the bottom end of this range. And then in terms of the US, the NASDAQ generally does outperform at times when we're seeing the sort of economic upwinds really sort of power through into the equity markets. Generally, we see this market selling off more heavily when things are going bad, but doing better when things are going well. We can see that here because we've seen a significant decline over the course of the past week and a bit. Generally, we have seen US markets sold off to a greater extent than European markets, and certainly that core PCE reading coming out last week does highlight the risk that we've essentially seen the end of that decline for US inflation. They're going to have to keep interest rates upwards for an extended period of time. We're actually seeing in Europe continuation certainly of that move towards the downside, but there's a differential between the two. We certainly have higher higher inflation rates in Europe compared to the US. But nonetheless, in terms of what we're seeing here, we've got this wider bearish trend here for the NASDAQ. The recent decline comes off the back of a rally into the 76.4 Fibonacci level. We've got this double top formation with the neckline now broken. Let's just move it. It's this level here. Let's move it here. So the neckline of 122.02 broken. We've come back into this 200-day SMA, and certainly I would say a breakthrough 118.17 does bring us greater confidence that we are going to see this market move lower in a more meaningful manner. But certainly if we look at, say, European markets and compare it to what's happening here, I know this is pre-market, but certainly we're seeing an underperformance here in terms of the NASDAQ, and that does really ring true with what we have been seeing recently anyway. A rise up through this swing high that we have here of 122.29 would essentially point towards the bulls coming back into play in a more meaningful manner. Until that happens, just like we've seen the DAX rallying up into range resistance, I think there's a good chance that near term we could see a little bit of upside, but we ultimately see this market fall off once again and turn towards the downside for the NASDAQ. So risks ahead, despite the fact that as things stand, we've started off the day on a relatively positive footing for equity markets. Looking at the FX space, we have seen a relatively clear-cut move of late. The US dollar really coming into strength as we see question marks coming into play for equity markets. Are we going to see a top? Are we going to see higher for longer in terms of interest rates from the Federal Reserve? Well, all of that really plays into the US dollar, and the US dollar has been dominating. The daily time frame shows you euro dollar really selling off in a meaningful manner from that peak that we saw at the turn of the month. And you can see that this month thus far has just been pretty much constant downside for this market. Friday continued that move, certainly moving us towards that key support level that we have here at 104.83. A break through that level essentially negates this bullish trend that's been playing out over the course of Q4 of 2022, moving into the beginning of this year. And so 104.83 is key. But essentially what we're looking at here is a trend that has been playing out for a month, and therefore, it's been relatively consistent. The 4-hour shows us exactly that. We can see here that we're creating this pattern of lower highs and lower lows recently, and certainly that has been sort of ramping up of late, with the fact that price action has really been sort of running away from itself. Previously, you could see that we're seeing sort of relatively decent swings. Now we're just seeing significant declines time and time again. The hourly time frame probably gives us greater clarity on that, as we can see here. Just trying to see if any of these trend lines particularly line up. Not particularly, but essentially they do show you the sort of trajectory of this market. Now, what we're seeing at the moment is that price action could be coming back towards this sort of deeper retracement of this latest sell-off. That would mean a potential move into your 105.83, 105.95. That potential near-term intraday descending trend line comes into play there. So a deep retracement here could come into play. If we see equity markets rebound a little bit more today, we could see a little double bottom formation. It looks like we've got a little bit of ahead of ourselves on Friday, so I wouldn't be surprised to see a near-term pop here. But unless we break the 106.14, I think near-term upside is there to be sold into for us to see a likely continuation of this bearish trajectory that's been playing out of late for euro dollar. Like I said, towards the downside, the key level to watch is 104.83. We break that, and then it has bearish connotations for the wider picture here for euro dollar. In terms of cable, we're coming into this 200-day SMA once again. You can see this is the third time that we've respected it. And we're also coming in towards this double top formation neckline, 118.41. If we break that level, we complete the double top, and that would point towards a more protracted move towards the downside for this market. Well, on the 4-hour chart, we can see that the creation of lower highs continued once again with this 61.8 Fibonacci retracement, as we see here. There we go. And then we sold off once again. But we're finding support around about this 119.16 mark at the moment. Near term, I think if we look at this hourly time frame, we can see that we have this near-term trend playing out. Top end probably got a trend line resistance around here as well, sort of roughly there. So I think there's a good chance that this near-term rebound, much like euro dollar, is going to be short-term in nature. So your sort of 1.2 mark is going to be key here, I think, for cable. Could see further upside from here, but unless we break the 12042 mark, I think near-term upside is going to be sold into for a continuation of this bearish trajectory we've been seeing of late. Keep an eye out for this confluence of the 100 and 200-day SMA towards the downside, and keep an eye out for 118.41. A break through those levels really builds confidence that this bearish theme is going to continue for cable. And finally, looking at dollar yen. Dollar yen's been outperforming of late as we see really a fight back against what we had been seeing previously. Essentially, we're seeing US inflation moving towards the downside, the Federal Reserve talking about a move towards terminal rates and therefore an end to their decision to continue upping interest rates. And at the same time, a shift over in Japan where we see continued upside in terms of inflation and a move towards the potential for them to start raising rates. Of course, a very different outlook because the US already has raised rates by a significant amount. Japan hasn't. But nonetheless, markets are pricing that differential. Well, things are changing a bit with the fact that the US is now pointing towards the possibility of even higher interest rates, and the fact that inflation is no longer collapsing like it was before, and now it looks like we could reach a point where it's relatively sticky and elevated, and therefore we don't necessarily see that same view of a relatively swift shift from the Federal Reserve. So that has all played into this bullish period here for dollar yen. The move through 134.77 ends this bearish trajectory that had been playing out over much of Q4 2022 and points towards further upside to come from here. So it's a case of playing it on this short-term intraday basis. We've seen this pop coming into play at the back end of last week as we see further risk off sentiment coming into play. So 134.06 looks the key level here. If we break that level, then it looks like this near-term rebound is over. Until that happens, it looks like further upside is here to stay. And certainly, I think a lot of the risk-off sentiment, given it's born out of fears of the US having to raise interest rates further, keep them elevated for a longer period of time. It means that risk-off is generally at the moment best reflected in US dollar strength rather than Japanese yen strength because of that, the way that things are currently playing out at the moment. So that's certainly worth bearing in mind when we're looking at different currency pairs to be trading. But certainly as things stand, it looks like we're going to see further upside here for dollar yen with a move through 134.06 required to negate that view. Looking at the commodity space, the US dollar strength we've been seeing of late has come to the detriment of precious metals. We've seen gold moving towards the downside. That comes off the back of a period of strength that we saw here at the back end of last year, moving into this year, but really it's unwinding in a relatively meaningful manner. This isn't necessarily a bad thing if you look from the long-term perspective. You know, I've been talking in the lead up to 2023 about the idea that I think this is going to be a big outperformer over the longer term once we move towards that phase that potentially the Federal Reserve could cut interest rates. We're just not there at the moment. The economy is doing relatively well, so there's no need for them to feel like they need to reverse course anytime soon or even stop their current rise in terms of interest rates, and inflation is slowing its decline. So that all plays into market fears, that plays into US dollar strength, and that comes to the detriment of gold. So we've now seen what I would say 3 significant weeks of declines, 1 week where we saw some indecision in the middle of that. I think there's a good chance we see more of the same, really. The daily time frame here shows you exactly that. We sort of see the odd bit of consolidation, then we're seeing the leg lower here with the breakdown through 1819. We've moved through this Fibonacci level, so that's now no longer relevant. So yeah, I just think we're likely to see more of the same. And ultimately, you know, as we always say, a lot of this comes down to what's happening on the near-term charts anyway. So, you know, we've got our sort of wider bearish view. How's that playing out over the near term? Well, we can look here and we can see the swing highs time and time again being lower and lower. You know, that is a market that you would think is likely to provide us with more of the same. And then when we see something different, that's when we can change our view. So 1846 is the latest swing high. If we break through that level, then we start to look at things a little bit more differently. But until that happens, I'm expecting to see further downside playing out here for gold. And then finally, looking at Brent crude, this has been a bit of a choppy one recently, but ultimately we have a bearish trend that's been dictating much of the past year. And we can see more recently we've rallied into trendline resistance. This latest rally, 76.4 Fibonacci level alongside this head and shoulders formation, and we've seen this breakdown from there. So the more recent rebound that we saw take shape took us in towards that 76.4. We didn't tag it perfectly, but we front run it a little bit and saw a sharp decline coming into play. Well, last week we also saw a rebound coming at the back end of the week. So you can see that initial decline, then seeing a sharp rally back up into the 76.4, which has been tagged today. So we can now shift that forward into the current candle. And we can see it has been tagged. And now we're starting to see some weakness coming back into play here once again. So I think there's a good chance that we do see this market just roll over from here. If we break the 84.06 mark, then we could move back into this descending trend line resistance. But certainly I think as things stand, we've got this bearish wider trend. We've got this market that's rolled over, much like what we've seen here. And, you know, this decline, it doesn't always work out absolutely perfect, like just one rally, straight decline. You can see here we rallied, pulled back a little bit, came into the 76.4. We've tagged it now. I think there's a good chance we see this market move low. And only with a breakthrough 84.06 do we start asking questions, but then we've got this descending trend line to contend with anyway. So as things stand, happy to continue to look for shorts here for Brent crude. That's it for today. If you want any more news and analysis, make sure to go onto the IG platform. Other than that, follow me on Twitter. My name's Josh Mahoney here at IG. Have a great day and good luck trading. Thank you.